Good evening, everyone. Thank you for joining the webinar today. Hope everyone had a good break during the December holidays. I am Anurati Garg, the co-chair for the Eurasia Asset Management Challenge 2023. Before we begin, I would like to thank today's sponsor, Bondsupermarket, a content aggregator for individual investors with presence in Singapore, Hong Kong, and Malaysia. Before we start the webinar, we have prepared a Mentimeter link for the Q&A session later. Can we please ask the participants to scan the QR code and feel free to ask questions that are related to the webinar. We will do our best to go through all of them. Tonight, we are pleased to have the opportunity to invite Wang Di-Ming to join us for this webinar. Now, I will be inviting Di-Ming to give a short introduction before we start the webinar. Di-Ming, please.
Okay, right. I'm Di-Ming. Don't need to be so formal and call me Mr. Wang. It's a little bit awkward. I'm not that aged. But yes, I'm currently a research analyst with IFA Singapore, focusing on global fixed income, or more like my job scope mainly focuses in SGD, Singapore dollars, or the bonds, mainly corporate bonds, which I've been writing several articles on our platform already, which you can go take a look on bondsupermarket.com if you want to know a little bit more about the SGD Corp's environment and how it has been working in Singapore, especially some of the recommended bonds that it might be of interest to recommend to your parents or whoever. I'm an engineering student, so not too particularly sure if most of you are from finance students or anything, but later I'll just do a very quick poll to kind of ask many of your background, so I know roughly how in-depth do I want to go into today. But for today, it'll be just a simple one. Yeah, so for me itself, I'm just going to take it easy. It won't be another lecture for you also. Look forward to speaking to you all. Do I pass away the time to you? Sorry.
Okay. Thank you, Di-Ming.
Right.
We will now proceed with today's topic, Introduction to Bonds and Singapore Government Bonds.
Right, so I can take over the sharing of screen. Give me a moment.
Yes, please.
Right. Okay. I have shared my screen. I hope you all can see the screen. Yes. Right. Okay, so for those who are here, I would really greatly appreciate it if you are able to turn on your cameras and kind of like, because it's quite a cozy environment, like we are kind of crowded in here. Your response, your reactions will I will greatly appreciate it, because ultimately I will know how I can move on, how I get the cues from your reaction, so I know how, maybe even if you're yawn, I'll be very grateful, because I know that I probably have to move on to the next topic. Yeah, so if you're able to turn on the cameras, feel free to turn on the cameras and join us for today. But if not, let us begin. Okay, right, so for today, quite a few simple topics that I want to introduce to you, or mainly for what I understand out of this challenge that you are attending. For this itself, from what I understand, that is mainly focusing on you doing a portfolio, creating a portfolio for the challenge, which ultimately from the predecessors that I heard from IFAS, I've heard that there wasn't too much of a focus on fixed income previously. So I'm kind of brought in here to give you a little bit more insights into fixed income, which I'll try my best. It won't be anything bombastic. If anything, it'll be quite simple, introductory, and I hope to really give you all some value through some simple stuff here and there. So coming to this, if you all don't mind, for those who are listening, can you all type in the chat what is your course of study? I just want to briefly have a view of what do you study, what's your background, so I have a better idea on like how extensive do I need to go into. Right, so whenever you're ready, please feel free to type in your course in the chat. I swear I won't harm you or anything. It's perfectly fine. I won't take it into the personal data. Right, a lot of business accountancy students. Exciting. Finance, yes, expected. Amazing. Banking and finance, yes. Right. Oh, there's a we have a comp sci student. That's quite amazing. Yes. It's greatly needed here. Data science. Lovely. Right. So actually we have quite a few students from different backgrounds. So quite interesting here. But okay, I guess that is all. Right. So I'm really grateful for those who have written down or who have input your replies in the chat. So Thank you so much. Let me begin with today's topic, or at least the first one. I wanted to give you through a simple bonds 101. Of course, this is mainly for a refresher because I believe roughly you have some simple understanding. But if not, don't worry. I'll mainly try to simplify it to make sure we are at least on some form of same level. So for the later topics that it will be easier for you to understand a little bit later. Coming to bonds, let me put a disclaimer. This is extremely simplified, a little bit overly simplified in a sense. So usually bonds, right, in certain simpler sense, right, it's just a debt. For this debt, it's usually, let's say you are the one lending money to an entity, be it a corporate or a government. You're lending this $1,000, for example. For this $1,000 that you lend to the corporate entity, be it government, let's just assume it's a corporate in this case. So the corporate borrowed from you $1,000. This lending cannot come at no cost. It won't become freely. You won't go to them free of charge and everything. You definitely will charge them something. And that something is interest. So in this case, the corporate will end up giving you interest over a certain number of years for whichever term or how long you want to lend them the money for, be it 10, 20, 30 years, so and so. In this case, the interest, do take note, for bonds, it's specifically called coupon. And why this thing is quite important later, you probably will see when I talk a little bit more about price later. This coupon, assuming let's say it's based on 5% per annum, it will be based on the original price that you lend, which is you lend $1,000. So this 5,000 on 5% on this $1,000, this will be $50. This will be what you earn for 10 years, assuming the term is 10 years. Until 10 years later, the corporate decided to return you the money. And that's where at the 10th year, you'll be getting back 1,000 plus the $50 you earn in interest that year. So I believe it should be quite straightforward, right? Of course, any questions, you can utilize the Q&A, or if you do feel that the question is extremely urgent, feel free to type in the chat. I'll try to address it at the same time. So this is a simple overview of bonds, but let me ask you some questions. So for bonds itself, I'll mainly ask the last one. Yeah, because for the interest of time. So for bonds itself, do you guys think it is a guaranteed thing? So of course, we like to talk about a lot of guaranteed investment instruments in the market, be it like fixed deposits. We know that bank gives us guaranteed interest rates and guaranteed money back. But do you think bonds are guaranteed? In a certain yes, contractually, yes, because contractually there is a certain obligation for them to provide you the interest rate, that coupon rate, and also the principal of 1,000, that assuming you lend $1,000. But in Singapore, we have seen more than enough examples of how this guaranteedness that people would assume go wrong. The number one prime example being high flux. So of course, whether the bond is ultimately guaranteed, it's dependent on the company's corporate profile, whether if they have the money at the end of the day to return you, to whether is it giving you the coupon or whether is it giving you back the principal. It depends on the company, whether do they have sufficient cash flow or even finances at hand. On the other hand, the middle part, something else I want to ask is risk itself, or something I mentioned is risk itself. So of course, we do understand that everything in the investment world involves risk. It's just a question of how much risk is there to undertake, even for fixed deposits, etc., etc. So for this risk itself, mainly for bonds, we love to highlight credit risk, reinvestment risk, and interest rate risk. These three being key to deciding how attractive a bond would be. But I'm not going into details. This is just some of the factors you probably want to take note if you are looking into some bonds yourself, or if you're looking into bonds into your portfolio that you're creating. Yeah, because I realize the case study is not out yet, right? If I do recall correctly. Yeah. So coming last point to bonds, liquidity. This is the question I want to ask. So if you all have some familiarity with bonds itself, can I quickly ask you, do you all think bonds are as liquid as equity, meaning to stocks? If you all think it is as liquid as stocks, please type yes. If you all think it is as not as liquidity as stocks, please type no. So I'll give you all 10 seconds to type. I'll see whatever answers that I have. No, 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 no. More liquid. Stocks more liquid, or wait, what? Okay. Right. So majority answers being no. Okay, that is lovely. That's great. So on the text of this, or for the context of this, in the first place, I believe you all do understand that bonds can be traded on the secondary market after the initial issuance. Yes. So for bonds itself, you can definitely trade on the secondary market. So in terms of liquidity, as long as there's a buyer, it is liquid. But how liquid are bonds themselves. In the very first place, if you are trading a corporate bond, typical Singapore corporate bonds starts from 250K onwards. That is for a 250,000. In that sense, you can probably imagine it isn't going to be as liquid as stocks itself, because stocks, in that sense, there is a smaller quantum that they need to satisfy in lots. The lots they needed to be traded in. But for bonds itself, minimally, they have to go at 250K. And on this hand, they have to be traded through counterparties, which might be limited in terms of brokers that there are in Singapore. So in that sense, the answer no is extremely correct, in terms that bonds itself is a lot less liquid, because it is hard to find counterparties that you want to offer at the correct price for. And secondly, pricing is also determined by the liquidity of the bond itself in the market. If the market is not liquid enough for the bond to be priced at, it is difficult for the bond to be priced correctly for the secondary buyer. So it becomes a cause and effect thing, vice versa. And it becomes a vicious cycle that, because of lack of liquidity, it becomes harder to price and becomes even harder to provide that liquidity. So this is something for you to consider if in the future you are looking into buying bonds, whether it be as a dealer or even as a portfolio manager, these are certain things that you have to take note of. Okay, so coming on to next slide. Right. So please do remember to mute yourself, because it will be quite interesting if we do overhear the conversations. But yeah, coming to next part, some very basic thing about how bonds work. Bond price itself, typically when bonds are issued, usually, not always all the time, they are issued at 100%, meaning to say for how much they are supposed to pay, they'll pay 100% of the price itself. This 100 will be usually based on a percentage basis. So usually when you see people pricing bonds at 99%, 88%, for example, is 88 out of the 100% of the total quantum. For example, if by lot or per lot is 250K, it will be 100% of that 250K, 88% of 250K, so on and so forth. But usually we just refer to 100 for easier reference. So if we do assume a 3% coupon, when the market or the interest rates environment changes, if the comparable yield falls below 3%, what happens to the bond price is that the yield on the bond has to adjust accordingly. So if you're assuming, or we do understand that this bond is providing you a 3% coupon based on the original price of 100, this bond price will actually increase. Can you understand? Still can follow me? So what happens is that because the comparable yield, interest rate, for example, with another on your 5-year Singapore government securities, that being a risk-free rate comparable to this 5-year bond, it falls to 2.5%. So what happens naturally for this yield on the bond, it will fall to roughly about 2.5% if you're ignoring the credit spread and everything. Based on this, the bond price will increase above 100 to ensure the yield is adjusted for to whatever is there on the market. And the inverse is true. So what happens when the interest rate goes down? The interest rate goes up to above 3%, the comparable yield goes up to more than 3%, we are looking at a decrease in the bond price to actually adjust for the yield itself. So what this entire topic is something that some of you might be exposed to, it's called the bond duration. Or simply to put, it is the interest rate sensitivity or risk when it comes to investing in bonds. It is mainly utilized as a measure to determine how much of the bond price will fall, or how much will increase or actually decrease when there is a subsequent increase or decrease in the respective interest rates. Of course, you do see the two formulas, but I'm not asking you to go and remember, because this is not a lecture, but it's just exposure in terms of, let's say, if you do have this interest in looking into bonds. Duration is defined as the average time to receive the cash flow from the bond measured in years. And this itself is referring to the formula on the left. So later on, you'll probably see the reference of the formula on the right in the next slide. Essentially, it's the time amount it will take for the investor to recoup its investment. In another term, it's mainly with regards to the cash flow, which I believe you guys are more than familiar with. Okay, so coming to this is a little bit better reference. So with adjusted and how you recalculate the modified duration, the Macaulay duration into a modified duration, you can understand how much 1% change in interest rates, right? How much of a duration change there will be in the bond price itself. So based on this, every 1% increment, there will be a change in 1% increment, there'll be a change in 5%, negative 5% in terms of bond price with a duration of 5 years. The inverse is also true. However, this duration for a lot of people, especially if you are a newer investor to bonds, they usually will confuse it with the maturity term or the tenor of the bond itself. So if a bond is 5 years or with a maturity to term of 5 years, it does not mean the duration is 5 years itself. As you can see from a formula previously, you probably don't need to memorize the formula to know that 5 years of the maturity term will not result in a 5 years in the duration. And of course, that duration will be affected by the coupon rate and also the current existing interest rates that will determine the yield to maturity. So this is something that you guys have to take note when it comes to dealing with duration. But I will probably believe that most of you already understand this. So moving on, next, bond duration, certain things that mainly affect the bond duration, coupon rate, time to maturity, and yield to maturity. When the bond has a higher coupon rate, what happens is that the investor is expected to recoup his or her investment amount earlier, leading to a lower duration. Of course, this is assuming nothing changes in the market, which is unlikely to happen, especially given what you understand out of this volatile period. We are still expecting quite a fair bit of interest rate changes, which will be brought up later when I bring in the Singapore government bonds. Of course, ultimately, we are looking at a shorter time to maturity or a shorter duration at the same time, right? It will lead to the principal amount to be redeemed sooner. So typically, we are expecting a shorter tenor will definitely imply a shorter duration, but it does not mean the tenor equals to the duration, except for some specific coupons or specific bonds itself. Ultimately, a bond with a higher yield to maturity will show a lower duration. Right, so I hope this is relatively basic, although ultimately, if there's no questions currently, we will see what questions or how many questions there are at the Q&A session later. So I hope I'm not confusing you all yet, or rather this shouldn't be too confusing. Yeah. So ultimately, something important is that duration can be used to understand your portfolio's interest rate risk, because in itself, duration is a method to actually calculate the interest rate risk that is exposed, that your bond portfolio is exposed to. When investors expect an increase in interest rates, their portfolio duration should be low. This is the case that you're seeing in in the majority of funds that are invested at this point of time. So even on our platform, for the fixed income funds that is currently majorly pursued or majorly invested on the Bondsupermarket platform, which is our sister company in a certain sense. Most of the investments are coming through are short duration bonds. If you have heard, now people are looking at money market funds, short duration bond funds. These are the ones being a lot more popular and drawing a lot higher or better use at this point in time, given the risks having to be taken. At the end of the day, we do expect that investors should be looking for bonds with higher coupon rates with a shorter time to maturity. This is always ideal. But of course, you do have to expect that higher coupon rates ultimately will come with higher risk itself. Vice versa, when investors expect interest rates to decrease, the portfolio duration should be longer. So of course, as we are moving throughout 2023, we are still expecting certain changes in the interest rates, especially with hopes in 2024 that interest rates will drop. We are hoping that investors are looking more towards a longer duration portfolio in the next 2 to 3 years. Right. Let me put next. Yeah, so talking all about bond duration, about how the bonds have their sensitivity tied, the bond price sensitivity tied to interest rate risk. Something else that I highlight is ultimately bonds do look very straightforward most of the time. Of course, we do expect that bonds will give out coupons, bonds have a bond price, it adjusts based on interest rate. That is all we need to know. And of course, that the interest rate or the yields will probably adjust when the company's credit go up or go down. But ultimately, in the market itself, it is not that straightforward because we have a lot of different varieties of bonds itself that is probably even, to a certain extent, is worse than equity market in terms of the options that is available there. In another sense, you can think of it as these are options or warrants being embedded into the bonds itself. So some of the bonds, especially the Singapore government securities, these are examples of zero coupon. For your MAS T-bills and your Singapore government T-bills, these are zero coupons, which means when you buy the bond or you lend the money to Singapore government, you're lending at less than 100. Typically, you're lending at, currently we are looking at lend rates of 97, 98, giving you $100, 100% at the end of the day. Other things we have is perpetual bond, Coming back to the famous example of majority that should know when you're looking into the fixed income market is the high flux bond. High flux was or is a perpetual bond that is on the retail market, retail space that is purchasable by retail investors. So for perpetual bonds, there is no maturity term. So in other sense, these are your preferred shares being offered by the company. Convertible bonds, these are the straightforward ones. These are the ones that are convertible to shares at the end of the day, or based on the option that's embedded in the bond itself. Of course, for SIA, probably the most well-known mandatory convertible bond on the retail space now, the SIA mandatory convertible bond, it is exercisable in 2030. So it is only exercisable, or this bond option, this convertible option can only be exercised when it comes to the maturity date of the bond itself. Lastly, floating rate notes, this one is a very straightforward one, which instead of having a fixed coupon rate, this coupon rate is quarterly adjusted to whatever floating rate it is tied to. And of course, on top of it, there's an additional spread. So while bonds can be very straightforward, on the other hand, there might be a lot of things that you have to take note to the bonds itself. If you are not talking about call options and everything, which makes all of this even more interesting. So this is just a very simple, straightforward Bonds 101, exposing you to some of the bond duration and also the several examples, not exactly examples, but several types of bonds that you might want to take note on. But more importantly, bond duration will be the topic that we want to take note for today. Why? Of course, mainly for portfolio, that is something that you have to understand, most importantly, when you want to create a portfolio for bonds. Right, moving on to our next topic. Initially, the intention was to write on Singapore government securities, but looking at how straightforward it is, and that being a risk-free rate that most of y'all should be taking reference from. Something of more interest to the majority or to the public now is the MES T-bills. If for those that haven't heard of T-bills yet, like you really don't know what is it. So T-bills has been on the newspaper recently. I have been asked by quite a few correspondents on the newspapers, be it Business Times, the Straits Times, even the Chinese newspaper. They have been asking for our comments on the T-bills and how we expect it to go so far, upcoming in this 2023. So of course, beyond T-bills, there's also Singapore savings bonds offering record high subscription. And most importantly, why T-bills got so popular is because on the bottom of the screen, you probably can see that T-bills went up to 4.4%. Currently, we are looking at negative performances throughout the equity markets. Of course, not all, but mainly from the major one would be global, US, even for China, they're offering at negative double-digit decreases, depending exactly where you're looking at. It can be quite different. But your Singapore T-bills is offering at 4.4% per annum, and it matures in 6 months' time. So looking into a little bit more for T-bills, why is there such a huge attention being brought into T-bills? This is just a simple comparison between your several conventional instruments that people like to look at: fixed deposits, Singapore savings bonds, and T-bills. For T-bills itself, being the blue color one, the middle line, you can see that the rates on T-bills has been the one that has the quickest adjustment upwards as you see the interest rates increase across the year. Meanwhile, while we do see Singapore savings bonds, which I believe you guys will know a little bit more about it, it has been adjusting upwards, but the exposure, or rather the variation in the interest rates, it is not as high as what T-bills is. And on the other hand, while fixed deposit rates has been increasing, you do realize that it's still lagging behind a little bit. But we have to take note, in November and December, the highest fixed deposit rates, they roughly have caught up to the T-bills use on T-bills already. So these are just some of the references to justify the popularity of T-bills and why has it been increasing so high quickly. Looking a little bit more specifically into data sets, some of the data that is more pertinent, this taken from Bloomberg. The Federal Reserve rate, the Fed funds rate has been increasing quite sharply for last year, for the entirety of 2022. If you all didn't know, really, you have been under a cave, you have not been exposed to interest rates at all. The Fed fund rates increased from a 0% to 4.25 to 4.5%. And we are still expecting it to be increasing over the next 2 or 3 cycles, depending which financial institution you are looking at. For IFAS ourselves, we are expecting it to go at least to 5%. and to be held at 5% across our 2023. That means we are not looking at the interest rate cut anytime soon, and this interest rate is expected to stay across 2023. For this itself, as you can see, for the T-bills yield, it has been adjusting to the Fed funds rate very relatively quickly. With each of the spike or ladder that you see is each option every 2 weeks for T-bills itself. So in case you didn't know, MAS holds the T-bills auction every 2 weeks. So there's always a new issuance of T-bills every 2 weeks, and for these 6 months T-bills. Okay, so this of importance. Why? Because as we can see, the 6 months T-bills is expected to follow our Fed funds rate quite closely. So what do we expect of the Fed funds rates or the T-bills use? Another thing to note is the correlation of the interest rates in US and Singapore. So I think this is something that you all probably have done some research before, and you all do know to relatively some extent. But this one is just giving you certain data sets across the different short-term rates. We are looking at 1 year Singapore government securities, your 1 year bond, Singapore bond, 2 year Singapore bond, and also your 3 month SIBOR. Of course, currently now we are in the midst of transiting to SORA, but SIBOR is still highly relevant. And as you can see, the trend is always the same. Whenever the US government, the rates are increasing, your Singapore short-term rates are definitely increasing at the same time. Although, of course, the extent of which we don't exactly know. If you can take a look in the middle portion, then you do note that against the orange part, which is the federal funds part, the Singapore rates do fall off a little bit earlier. So that is in case as a personal investor, we are looking in when is the best timing to buy into T-bills or doing your own investments. The best time might be coming soon. Yeah, so please do take note on that. Of course, coming up to next, this is the currently implied Fed funds rates, or this is what the market expects the interest rates to be across 2023 until 2024. Of course, despite the Federal Reserve's warning in the Federal Minutes that ultimately they are not looking or expecting a rate cut in 2023, the market still expects to see a rate cut coming the second half of the year onwards. So who will be the winner, we don't exactly know. At the end of the day, it still depends on the inflation situation in the United States, and we are still waiting to see how it will develop. Given now the current situation, which I believe there will be other speakers speaking on macro, you probably have a better understanding. Ultimately, with the current situation on China being able to open up, we are expecting inflation to actually shoot up a little bit more, and for the inflation situation to actually worsen globally. Right. So coming to this, at least from this, with what the Federal Reserve is expected to do, we are still expecting the interest rates to go up a little, especially on the use on T-bill. So ultimately, what does this mean? This also implies that over the next 2 or 3 cycles of Fed rate hikes during the federal meetings on almost every monthly basis, we are still expecting the T-bills used to adjust to the incoming rate hikes. Maybe not to the full sense, maybe not to a full amount of how much that the Federal Reserves are increasing, but we are still expecting a slight increase over the T-bills use. Coming to the most important question of the day, why does T-bills matter to you as a portfolio manager? Some of the short duration funds that we mentioned, that I previously mentioned, being the most popular on the platform right now, for investors to look at because of how safe they are and how high of a yield that they are able to offer. These are the top holdings that is inside of these short duration bonds. And a commonality you can probably see in most of it is either MAS bills or Singapore T-bills. Of course, on the MAS bill side, MAS side, they do offer they offer a 1 month bill, 3 months bill, 6 months bills, and a 1 year bills. But of course, only the 6 months and 1 year's bills are offered to retail investors. As an institutional manager and institutional manager, for your funds, you definitely will look at the various options available. And currently, one of the most hottest investment options available now, not inclusive of fixed deposits that's widely pursued by the elderly, is our money market funds. A lot of people are turning their attention to money market funds because of how fast it has been adjusting. I probably shouldn't be saying this, but of course, in our competitor platforms, each kind of places, StashAway, robo-advisory, Scythe, their cash management portfolio, they are doing all the advertisements, and you probably will see from there on how high or how fast the yields have been adjusting. Similarly, through Bondsupermarket and through iFast, we do have cash management accounts also. And even if you're not looking at cash management accounts, we also do offer money market funds for our clients. And these are the most popular currently, most sought after funds by investors who are looking for a low risk environment and low risk place to park their monies in. Of course, coming back to the question, why does that matter? Because ultimately for investors, they are constantly looking out for opportunities. And when opportunities are not present, they have to find something liquid. And this is just one of the options available to them. But does it matter to you as a portfolio manager? So ultimately, you can probably tell from here, there's a lot of reliance on bonds or Singapore bonds at the end of the day, be it for the risk-free rate or be it for the, not for the risk-free rate, be it for the reduction or the minimization of the risk you're exposed to at the end of the day. Yeah. Okay, so maybe there is that. Portfolio management, just a little bit more on bonds itself. Of course, I believe that there will be other speakers that's focusing a little bit more on asset management and how everything. But I've heard that the exposure towards bonds is relatively limited. So I'm providing some viewpoints when it comes to the bonds itself. How does the portfolio of pure bonds, not say pure bonds, but when bonds are involved in your portfolio, usually how do they work? Okay, so for fixed income portfolios, some of the common practices or some of the more common strategies, we are looking at a bond ladder. A bond ladder, it is as straightforward as the example you can see here. It's ultimately looking at different bonds maturing at different terms of increasing increment. So it could be for the fact that you are, as a fund manager, you are buying bonds every 1 year for bonds of every 2 years maturity, or you are buying for this year, you are buying a 2, 3, 4, 5, 6, 7, 8, 9 years to maturity. This is allowing you to ladder across the entire period you are looking at, assuming you are looking at a 10-year objective or 15-year objective, so that you are able to capitalize on whether is it increasing interest rates, also depending on yield curve itself. Second option is bullet. Bullet is very straightforward. Ultimately, what bullet means, right, is that you are looking at all the bonds that is maturing at a given specific point of time. So if you are buying all the bonds now, you could be buying all the bonds that are maturing in 10 years. If you are buying across 5 years period, you are looking at everything that is going to mature in 10 years time also. So meaning to say, even though you are buying a bond 5 years later, you are only buying a bond with 5 years maturity at that point of time. So all your bonds will mature and provide you the principal back at the same timing. Last but not least, barbell. Barbell is also similar to bullet, except it's divided across a different time, which ultimately consists of a short and a long term, as opposed to bullet, which has a medium overall term to maturity. So you're looking at a short and a long duration portfolio at the end of the day, combined to give you the same average portfolio as a bullet portfolio. Of course, several considerations here, but I won't really go through them because I think they're mostly quite straightforward. These are just some of the different considerations that will allow you to think of which one will be the best. But of course, that is the more exciting part to think about. So in case you missed it, question. So for those who are a little bit more familiar with the current market situation, for those who have been reading things here and there, analysis here and there, what is said to be the best predictor of a recession that is time proven? Maybe not this time because there are some other sayings, but for previous, all the way in past history, this has been the golden example of a predictor of recession. Any guesses? Please type in the chat. I shall see. Okay, inverted yield curve. Let me see if there's any other answers. Any more? Housing price. That is pretty exciting, but technically you're not wrong. Any other thing? Okay. Right, so quite interesting. Housing price is honestly an extremely good guess. Of course, I didn't really think of it at the spot, but I would have to say it's pretty good guess because housing price is ultimately tied to inflation. And particularly for Singapore, if you haven't been realizing, housing price, the rise in housing price is a huge part of inflation also. Of course, ultimately looking at the inflation that consists of everything or just looking at headline inflation. But yes, the actual answer that I'm looking out at is the inverted yield curve. So inverted yield curve has been the golden example as to predicting a recession. And currently, ever since the second half of last year, when the interest rates has gone haywire in the US market or even in Singapore, the inverted yield curve is currently kind of predicting or expecting the one that is predicting an incoming recession in 2023. what we are expecting a mild recession to occur in the US. But for Singapore, thankfully, based on our expectations and also MAS expectations, we are looking at Singapore to have a near miss in terms of recession. Because at the current point of time, MES is predicting a 0.5 to 2.5% GDP growth in year of 2023. So in case you didn't know that, that is something that you probably want to might read on when it comes to understanding Singapore's GDP. But coming a little bit more on yield curve itself, of course, in most circumstances, what we want to expect, right, is a normal yield curve, whereby over the longer term, we are expecting a higher yield as the maturity increases. Why? This is to compensate for reinvestment risk. As the longer term of a bond that you have, the greater the reinvestment risk that you have to carry. And typically, this is compensated by the higher yield you are getting on the bond itself. But currently, we are seeing the situation of an inverted yield curve in most places, maybe not with the exception of Malaysia, with the slight exception of Japan. For US, we are looking at a very strong inverted yield curve with the 2s and 10s, the 2 years and 10 years coming off at a very inverted. Even for Singapore itself, we are looking at a slightly inverted yield curve. Next slide. Right, next slide is okay. Yeah. So this is a figure on this is a data set that we have on our Bondsupermarket website. We present on all the yield curves across the world, US, Singapore. We have quite a couple of the yield curves being shown. This particular yield curve is Singapore's yield curve. As you can see, the lower one, the blue color one, this is what you are expecting of a normal yield curve, that it should be increasing with time. 2 years across 30 years, the longer to compensate for the increasing reinvestment risk that you undertake. But currently, the orange one, the green color one is the one happening to the Singapore market at this point of time. This is not forgetting that the current T-bills rate, 6 months and 1 year, that should be included here also for additional reference. It is currently at 4.2%. So if you imagine that you can probably see how inverted the yield curve is, that currently we are completely lopsided to the shorter period rather than the longer period. And how does it suggest for your portfolio or what strategy to take? Under stable upward sloping conditions, whereby in a very normal environment, whereby all the economies are growing, is growing very well, it's very healthy, inflation is at a healthy rate, your GDP growth is at a healthy rate, your normal yield curve should be upward sloping. In that case, an even ladder is the most optimal, because across the different years that you have, you're able to diversify and average out your duration, such that even if any interest rates movement, you won't be affected too much. However, in the situation now that we are facing, whereby looking at a flattening yield curve, the current focus on is actually looking into the short-term plus long-term rates. But of course, currently most of the portfolios that is being more popular are purely the short-term bond duration. But the barbell strategy works. Why? Because as the yield curve continues to flatten, the short-term duration is able to compensate for the losses in the long-term duration. This is something that will probably be helpful if you go and read out on your own. But in general, these different strategies will be helpful in different point of times whereby there are different yield curves or situations for them, for the investors to kind of look at. Yeah. So for those who are aspiring to be a portfolio manager, this is something that will be useful for you to see in the future. Ultimately, just to promote our Bondsupermarket platform, whether is it you are aspiring investor, you're planning to look at bonds, be it now in the future, because we do offer the looking at retail bonds also. We are able to build on your personal portfolio in terms of how much you want to be setting aside based on the different bonds that we do offer. Of course, you do realize that majority of the bonds they're offering at least at a 250 to a 500K kind of quantum, but it is still amazing for you to build a sample portfolio, which will be useful, I believe, for your upcoming portfolio challenge. Also, on the other hand, we have different subtypes that allows you to quickly see what kind of bonds you are looking at, be it whether you are looking at a high yield corporate bond, you are looking at a quasi-sovereign bonds, or you are looking even at sovereign bonds given by the government. Sector-wise, don't need me to say it's very straightforward. And even for the bond subsector, okay, this one is not very important, so I'll just leave it here. So this is something, some stuff that the Bondsupermarket platform is able to offer you in case you are looking for something reliable to build your bond portfolios for the upcoming challenge. On the other hand, in case you are a little bit fresh into the bonds portfolio, you're not exactly sure what you want to get exposure to. What are bonds? We have some simple, straightforward articles towards bonds to whether it's reading a bond fact sheet to understand certain things that you take note, or certain features when it comes to core features, some of the issuer core options. These are some of the things that you do have to consider carefully when you are investing into a bond. Lastly, also not forgetting featured insights into our bond articles. So on a weekly basis, we do have updates or recommendations on certain bonds, or even just insights into some simpler bonds issues. So for example, the previous week I wrote on Sing. I'm not sure we have heard of this company before. It's a real estate developer company in Singapore. Sing, recently, if you do see on the SGS market, they have privatized SP Corp. And if you do follow, they currently have some cash, I would say issues, but they have been using quite a fair bit of cash, which ultimately will greatly affect their credit profile if they do not manage their cash situation carefully. So these are some of the things that we write on, and offering some of the insights into bonds and certain things that you probably want to look out for if you personally are buying into bonds. Of course, on the right hand side, you can see that we do have podcasts also. Our podcasts are available through Spotify in case you want to listen to something interesting. And even if, let's say, especially for those who are exposed or who are following the China property developer market, the Chinese developers, if they have defaulted, what happens to the bond, and whether if you should be worrying or you should not be worrying. Of course, you have to worry, but it's just that how much you have to worry about it. Please do connect with us. We are available through a relatively huge amount of platforms. Yes, I use the term relatively huge amount. We have LinkedIn, we have Facebook, we have Telegram, we have Twitter. Most importantly, do join us on our Telegram, because on our Telegram, we have our regular updates on certain bond issuance. We have certain updates on our bond offerings. So this is something where you can keep track to see what are the new offerings at this point of time. Not forgetting our podcast, the U Hunters, that is available through Spotify, Google Podcasts. And you can join us to listen to some stuff interesting in case you are looking for something interesting to listen. Yeah. With that, I have come to the end of my presentation. I believe we'll move on to the Q&A now.
Yes, thank you, Deming, for the insightful sharing. It's been such an informative session. I believe a lot of you will have questions, so we will be flashing the QR code again in case you missed it the first time. Please enter your questions. So.
Here we are. Okay, so I think I can just answer this question first. So for the bullet strategy, ultimately, what happens for the bullet strategy? Let me refer to my own slides again so I can roughly see. So for the bullet strategy, right, what happens is ultimately, how do I want to say, the bond maturities are being concentrated in the middle point of the yield curve. Because of that, when your bond prices, when your yield curve steepens, how should I say? When your yield, okay, so comparing between the two, barbell or bullet, these two are supposedly similar because ultimately you are looking at a similar bond duration. The bond duration will average out to be similar because you are looking at, of course, a short plus long to give you average to a middle. And of course, the average middle for bullet itself is just middle. That one quite straightforward. When your bond, comparing between the two options, when your yield curve flattens, the barbell will be a better option because this will compensate for the short-term increases, will compensate for the long-term decreases. But this does not exactly mean that your bullet strategy is not good. The bullet strategy is optimal in that sense. It's optimal for both. It's just that ultimately in the longer term or in the opposite term, opposite situation, which your yield curve is steepening, that means you are looking at your interest rates in the longer term increasing. What happens is that your barbell strategy will be more affected because your long-term decreases will be more than your short-term increases. Can you understand? Yeah. So between the two, actually your barbell and your bullet strategy, the main focus is having an average maturity, average duration of being very similar. But when it comes to changing environments, the bullet will be better in terms of this scenario, whereby the scenario affects the barbell more, whether is it by better or is it by worse. your bullet is simply just a more resilient portfolio overall, in certain sense. So the ideal market condition to employ such strategy when the market is steepening, when the yield curve is steepening, that means you are expecting your longer term interest rates to increase, which also means that it's not so soon. Probably in 1 year's time when your interest rates have fully stabilized and you're looking at the federal funds to reduce, the Federal Reserve to reduce their rates. Yeah. Okay, are y'all flashing the other questions or? Is there a reason why government bonds are zero coupon? That is a very good question. To be fairly honest, I don't think I have an answer, but I think mainly it's because you do realize, right? Okay, of course, this one let me do clarify. So not all the government bonds are zero coupon. Mainly the government bonds that are zero coupon, right, are 1 year and less. Of course, typically when you guys 1 year and less, right, it's a lot easier, right, or less administrative issues when it comes to issuance of the coupons itself. Because if you are giving out semi-annual coupons for less than semi-annual term maturity term bond, which is your 3 months MES bills, for example, then it doesn't make sense. Because typically in the market, people are expecting to see a semi-annual coupon on every bond or on most bonds that you see. So in this case, I don't think there's a specific reason as to why government bonds are zero coupon, but I think in general, the market structure allows for, let's say, between a less than maturity term of 1 year, it makes more sense for them to have zero coupon because it is easier for them to operate that way. So it's just that you will take the price difference or the capital gain on the bond price as the use itself. I hope that answered questions. Okay. What affects the bond price more? Is it coupon rate or time to maturity? This is a very difficult question because you're ignoring, not say ignoring, you're forgetting another factor, which ultimately both depends on interest rates. Of course, this coming back, right, is the duration question itself. And for this itself, it will be a lot easier if you do calculate the duration and how the convexity works, which in going into it is a very long lecture. So for this itself, there are quite a lot of good resources on the internet that will teach you and to kind of go through with you on the idea of convexity, which will give you a better idea whether the what affects the bond prices more. Is it coupon rate or time to maturity? Of course, just a general rule of time. In terms of coupon rate, for what affects each one more, right? It depends on whether you have a higher coupon rate or lower coupon rate, and also whether you have a longer time to maturity or a shorter time to maturity. The factors, these two factors, or how long or how high it is, will affect to the factors that determines your bond price. Yeah. So it still depends on other factors and also ultimately what kind of interest rate they're exposed to. But this entire thing itself, the topic you are looking at is duration. Yeah. What is the best time to convert the convertible bonds? Is it as soon as the underlying stock exceeds the conversion price? Honestly, this question, it works more for as a equity question rather than the bonds question. Because bonds itself, the value of the bonds, of course, if you want to take everything on a surface value, it depends on the price of the bonds. So when it depends on the price of bonds, it depends whether if the bond is a zero coupon bond or the bond pays a coupon. If it's a zero coupon bond, great, because it is not likely to be affected by interest rates, which is what we are seeing in the SIA mandatory convertible bonds, but those you don't have the option to convert. For most of the convertible bonds itself, you do have to realize that you don't really, not all of them you have the options. Most of the time, the option to convert lies on the issuer, not on you. So if you have heard COCO bonds, contingent convertible bonds, these are based on the conditions of the issuer, not on the investor. So of course, in exchange, they do offer higher coupon rates. So for this, I'll come back to the question, is it as soon? It's not such a straightforward answer that I can just give you. Yeah, but I think ultimately it depends on the equity itself rather than the bond. You have to look at whether how the equity prices is expected to change. And therefore, when you do the conversion, if you can exercise the conversion, whether is it at the best timing will depend on the equity or the share of it rather than on the bond. Yeah, I hope I answered the question, although it's very vague. Yeah. Okay. For the Mentimeter, okay, let me go in to see. I haven't. Okay. Give me a moment. I see the question whether if we prefer to use McCauley's or that's an amazing question. Okay. McCauley's duration or modified duration, actually both has a use. So ultimately it depends on the bond that you're analyzing or what purpose it is. Because of course we are looking this current period, we are looking more importance to modified duration. Why is because for my side of things where we are doing a little bit more research, we are making recommendation on bonds, we are looking at how sensitive the bond prices would be when it comes to interest rate changes, because we are still expecting quite a fair bit of changes in the interest rates. But of course, underlying this, there's still quite a lot of assumptions that you have to see. How much are we expecting in terms of changes for the interest rates? Which means in a comparable yield, we are looking at 5-year Singapore government securities or even a 5-year sort of a rate. These are the most common comparisons when you're looking at perpetuals in Singapore. So we have to do a comparison against like, oh, based on, let's say I'm looking at a 1% change in this, how much of a bond price we're expecting to change. And this change, is it good for the investor or is it bad for the investor? But of course, this is in our situation whereby we are doing the analysis of the bond to make a recommendation, because facing the clients, we have to give a recommendation to let them know how much expected yield they are expected to earn from this bond purchase. But of course, on the other hand, if I'm not wrong, portfolio managers have a greater interest in McCauley's duration. Because for them itself, the main objective of the portfolio is to look at, for example, short duration or long duration. So in the very first place, they have to determine whether is it a short duration or long duration. But definitely both are very useful. Both are something that anyone looking at credit, anyone looking at bonds, they definitely have to look into. Looking at the market in 2022, what do you think will happen to the fixed coupon amounts? That's a very interesting question. Of course, if I'm assuming you are asking for newer bonds that are going to be issued in 2023 this year, what are we expecting to the fixed coupon rates, or how much of the coupons are we expecting? Because of the current interest rates, we are still expecting adjustment. And of course, the companies, they themselves are expecting adjustment. The interest rates are not at a stabilized level yet. Because of the interest rates or the expectations of interest rates are still increasing, a lot of the issuers, they don't dare to issue. Because you can issue now, but imagine, right, other investors are expecting another bond to come out tomorrow at a higher price. It is likely that your bond at this current given amount is not going to attract enough investors. So what we are expecting now is that the rates are supposedly very high. But in this supposedly very high environment, are there any issuers offering any SGD bonds? The answer is no, because the rates are too high for them to even consider. Yeah, so I hope I answered your question, but mainly it's because thank you, we are expecting the fixed rates, right, to be at a high now. But because it is expected to be a high because of how we compare against the interest rate environment where the interest rate is also at a high, issuers are not issuing on the market because of the difficulty. Imagine all the additional charges, right, they have to incur, and the high rates that to incur, when technically they can go to the bank and get slightly better rates depending on how much of a quantum they want to get. Of course, looking at other markets, right, if you're looking at Japan yen, there's a lot more offerings, euros, pounds, and there's a lot more offerings. Depending on the currency, it might be slightly different, but this is what we're observing in the SGD market currently. Just to clarify the next question, why is it better to stay lower duration given the market conditions? Since we're expecting the Fed fund rate to peak and decrease, isn't a longer duration better to capture the bond? You are absolutely correct, except that we are not expecting the Fed fund rate to peak yet. So we are still expecting to increase, right? The increase will ultimately kind of let the short-term duration to be even better. But of course, if you are really trying to time the market, the best time to actually enter the portfolio or enter the market is when it reaches the peak. Does it make sense? But of course, whether if anyone does have a crystal ball to really do that, the answer is no. So of course, the best bet is currently short duration, because the majority of short duration, you are taking on a lot lesser risk, be it interest rate risk, reinvestment risk, and especially let's say you are buying a bond at less than par, that means less than 100. The pull to par effect will allow you to earn on the bond quite easily, rather than you having to wait for the coupon to be issued out. So currently, another reason to, let's say while you're looking at short duration, typically the longer duration ones is additional risk that you take on. What we are expecting out of this year and the next year is recession, correct? We are looking at a global economic slowdown generally in most places. Even Singapore, definitely we are looking at a slowdown. It's just that it's not as drastic as a lot of places. What this also means is that a lot of companies, we are looking at worsening credits. So the worsening credit profiles, this will, of course, simply put, it's just that they take on more risk. Whether is this risk going to be worth it, it is very hard to say. Because your risk-free rate is currently at 4+%, will you be willing to take on risk at 6+% and realize that there's a potential chance for you to default when you can just take on 4+% without any chances of default? So another issue is probably now the short-term rates are extremely high. These are a lot higher than the long-term rates that you are seeing. Okay, so I hope that answers your questions. Wow, okay, there is quite a lot of questions I'm seeing. So why high coupon rate lead to lower duration? Because high coupon rate, based on the adjustment of the changes in interest rate, there's a more drastic change in your prices. So if you think about it, wait, I also got confused. This one itself, right, is easier for you to read out in certain resources than for me to explain, because there is going to be a slightly longer text to kind of to look into. So, but slightly high coupon rates will generally be helpful. Actually, wait. This question is slightly okay, I might have said something wrong just now. So high coupon rates technically should lead to a higher duration because of increased sensitivity. But this one also depends, because depending on the point of the curve that you are at, it also affects whether you are increasing your duration or decreasing your duration. But of course, also depending on how the interest rate changes. So quite a few assumptions here. But in general, for duration stuff, it is going to be quite complicated for me to explain without any references, especially I will need the graph, but I don't have the graph here. So that is something that you probably will want to refer to when you are looking at any duration issues, to kind of refer to the graph, whether based on the gradient of the graph and also the second derivative of the gradient, that means on the graph, is how is it changing. That will give you a better idea on how the duration and the convexity will change. Yeah, so short answer is, I can't really answer this question because I kind of need the graph, but I think it'll be easier for you to refer to the graph and you will get an easier answer from there. Yeah. So next question, please. Oh, okay. This is quite interesting. Right. So can you elaborate more on the bond situation in China? So I believe currently you're probably, if you guys have followed the Asian high yield market, you probably have seen on how the market fell very sharply across the entirety of 2022 and also increased very sharply as soon as China decided to backtrack its zero COVID policy. So of course, the bond situation in China, we are hearing slightly different things based on whatever that is being given out. Because previously in the middle or in the later part of 2022, we heard that, or rather the news that we get is that the government will not be providing any support to the property developers. So in that case, we have seen the Asian high yield dropping from 100 on a dollar, not say 100, from 80 plus on a dollar to less than 50 on average. But currently we are seeing back to 60, 70, a certain rise after the zero COVID opening, plus that the government has indicated that they would support the property developers that was indicated or that has highlighted to be too big to be failed. So initially the government didn't want to bail them up or to help them because it mentioned or it thought that they were too big to fail. But currently they are thinking of certain solutions to actually help them. So we are still expecting, we are still seeing the market on how it will change. Yeah, but basically we are still not very positive on the Asian high yield market because of how drastic it can change. And a lot of the bonds available in the Asian high yield market in China, they are still majority mainly are distressed debt. So we are still expecting a lot of restructuring, and this restructuring can still fail. And secondly, property prices in China is still not increasing. So currently the future, or rather the situation of housing prices in China, is still looking a bit bleak. So we don't actually recommend clients to go into China at this point of time, based on the lack of information that we have. Yeah, I hope that answered your questions. Thank you, Feng Yi. Yes, so you can read that. So these are the top 30 key Chinese developers. Some of it are highlighted here. Evergrande, Shimao, LV Gem. These are quite some of the more popular developers in China that got very affected of how the housing prices, or rather the whole collapse of the property market in China. From an asset allocation perspective, what do you think is in ideal allocation rate to bonds under current market condition? There's no answer to this. Ultimately, it's depending on your portfolio of what you're looking at. If you are looking at a full equities portfolio, it kind of doesn't make sense to ask that question because you're looking at full equities portfolio. So ultimately, it's still kind of based on your portfolio or your profile, what you're advertising to clients or what you're advertising that bond profile is. But generally, for most of the fund managers now who are of a balanced portfolio, meaning to say they have a mix of equity and bonds, they are mostly or if not all overweight on bonds at this point of time. Meaning to say from the original allocation, be 80-20, 60-40, they have a slightly higher allocation toward bonds by 2.5%, 5%, depending on how the market is adjusted, because of how the current market conditions are, simply put. Yeah, so that is just a general summary. So although I cannot give you an actual answer of what's the ideal allocation rate, but currently we are seeing all the majority of the fund managers, they are overweight on bonds. So they are placing a higher allocation with bonds, especially short term, short duration. Yeah, so I hope that answers your question. Can I have the next? Why Singapore interest rate tracks Fed fund rate closely? To be very honest, I don't think there's a really why does it track closely, but mainly because Singapore's I believe you guys do already understand that most countries have their own monetary policy. For US, it's by interest rates. By China, also by interest rates. By Japan, also by interest rates. But by Singapore, it's by our foreign exchange rate. So instead of controlling our interest rates, Singapore controls our foreign exchange rates that is being seeing our S-near rates. So they are currently being kept at the top of the policy band. What MAS is doing that currently, mainly to fight inflation. So by increasing the power of increasing the strength of Singapore dollar, it becomes easier or less effects of the inflation will be passed on to Singapore, especially Singapore is an import-based, trade-based, trade-reliant country. So if a lot of our what we needed to be imported from other countries, having a stronger dollar will kind of reduce the effect of inflation from overseas, which currently we have seen is quite true. That Singapore's inflation is not as bad as what is happening in US, in euros, even though technically we are importing all their stuff. And also Malaysia, not forgetting. So ultimately, the main reason why Singapore tracks Fed rates closely is because we don't control the Singapore interest rate. This is being allowed to float freely. And one of our most major partners that we trade with is thankfully US. So with United States, we inevitably follow the federal rate quite closely. So there isn't really a particular mechanism because ultimately, if let's say the Singapore rate doesn't follow closely enough, the banks in Singapore will suffer because they are not able to loan at a good rate, they are not able to borrow at a good rate. People will be flocking to USD rather than looking into Singapore, which will undermine the strength of Singapore dollar as well. Yeah, so that is in general a summary. I think I'll take one last question because I think there's been quite a fair bit of questions.
Yes.
That was the last question.
Okay, perfect. Thank you for taking all of our questions. Is there another one? Is that a new question?
I think there's a new question. Okay, this will be the last question. But of course, if you do have any additional questions, you can feel free to ask for my contact. I will try to answer to the best of my abilities. What are the considerations when it comes to choosing which sector geography to invest in? Same answer you probably will have when it comes to looking at equities. There's a lot of things that to consider. Different sectors, whether you want to look at property, which is mainly Asian high yield, whether you want to look into healthcare, whether you want to look in REITs, whether you want to look in tech. Okay, tech not so much. Okay, first thing first, it is not as the options are not as wide as equity. Not all companies that issue shares or are listed will offer a bond. Typically, when bonds are being offered, they are offered by companies who are expected or who requires quite a lot of financing. We are looking at REITs. REITs requires this financing to purchase properties. Banks requires this financing so they can lend out money to more clients. So typically, you have to look into what sectors do actually offers bond in the first place. So things like tech is relatively limited. Not too much of tech companies will actually offer bonds, but also depending, some companies still do. What are the considerations? One, currency. You have to consider the strength of currency. So different currency, different interest rates. USD, Chinese yuan, or you are looking at offshore renminbi, you are looking at Japanese yen, you are looking at Sing dollar, even Malaysian ringgit, British pounds, euro, each of it have a different interest rate yield curve you are looking at. And what is the most optimal one for your own consideration? That one is something you have to think about. Of course, you are looking at Japanese yen. People are looking for Japanese yen for the stability because they are not adjusting as much as other countries. That is something that you probably will want to look into because their interest rates is still at negative 0.1%. For now, we are not very sure whether it will change, but we are expecting it to change slightly as the inflation rate kind of worsens a little bit more in Japan, but also maybe in the United States. Even let's say comparing between United States and Singapore, what is the expected currency for exchange that you are expecting also? Because how the interest rate changes will result in how the currency will be affected. We are looking at a strengthening Sing dollar, and in 2023, our house view by iFast is that we are looking at a weakening USD. In that case, will you want to be investing or buying into USD bonds when there is not much capital gains? You're just mainly looking at your stable income through your coupons, but you're losing the strength of that, you're losing the value of that coupons because of forex exchange. So all these considerations will come into mind. But mainly coming back again, sector, it depends on what kind of sectors, does the sector even offer bonds in the first place? But of course, sector-wise, you have to really consider the strength of the sector already, like defensive sector or growth sector, etc. That one is same as equity, so I probably want to answer you that. Geography-wise, you really have to think about currency because the interest rates will affect the currencies greatly. Yeah, I think that's all I have to answer, and I hope that answered questions. Yeah.
Thank you, Deming. So with that last question, we will be wrapping up the webinar for today. Thank you everyone for joining this webinar, and I hope you were able to learn about the interesting topics covered by our speaker today. Before we end today's event, I would like to bring to your attention the upcoming webinars on Tuesday by iFast Singapore and Wednesday by Paragon Capital. With that, we have come to the end of the session, and we hope you enjoyed the session and managed and learned as much as we did. Thank you.
Thank you all for having me here today too. Thank
Thank
you.
you.